In this session, I'm going to talk about the yield curve. And this is very important for people that are invested in real estate because this is something that determines what your mortgage rates are going to be and to tell whether there's going to be a recession or an expansion. Now, the yield curve, the normal one, is an upward sloping yield curve, which has shorter term yields that are lower than long-term yields, say the 10-year, that's going to be a lot higher. So that means that if someone's going to put money into the bond market, they're going to want to have higher interest rates if it's going to be put into something that's a longer term. So, for example, home. Now, what happens when the market starts to slow down? It's possible to have a flat yield curve, which is a period of uncertainties because you're not determined as to whether the market can be good, or it's going to be a recession, or if the market continues to expand. It's the inverted yield curve that's very important. That's what a lot of traders actually look at and investors, because it's the inversion that tells you that there's going to be an economic contraction, a recession. So we've had that since April of 2022. It started to invert, telling you that it is possible that there's a recession and interest rates had increased by a considerable amount. So a lot of money was being taken out of the market and put into longer term securities, bonds. A lot of traders and investors, they look at it, and that's the yield spread. And the typical one, a very popular one that people look at, is 2-year and the 10-year treasury note spread. That means like they take the 10-year and they subtract that from the 2-year spread. And when that dips below zero, that means whatever rates are 10 years, subtract those for 2 years. If it's negative, it's a very strong indication. And in the past, it provided a very good measure as to whether a recession occurs. So let's take a look at history. Now, in the late 70s, this occurred where 2 years and 10-year yields, they kind of flipped and they became negative. And what happened following the 1970s, there's a recession. Then we look at the yield curve in the early 90s, just before the technology bubble had burst into the year 2000, 2001. In each of these cases, the yield curve had provided a warning that there's going to be a problem in the stock market. Just before 2008, there is this dip just below zero, and then you had the Lehman crisis. Now we move that all the way up to 2020, and just before 2020, the spread between the 2 and the 10-year, it almost dipped below the zero line, but then it went back up because of COVID, because what happened was the interest rates were dropped considerably by the Federal Reserve and also in Canada. And then you had the spread going back up again. Well, as of 2022, spread dropped right below the zero and it's going a lot deeper. This yield spread provides an indication as to when we're going to have a recession. And it tells you that this is going to be somewhere between 6 to 18 months before we have a recession, and that would probably put us somewhere into Q3, so that's around September. How long the recession lasts is really a question mark, and it's probably a bit too difficult to really determine because markets are dynamic. So real estate does go up in the long term. You just have to go through these cycles, and if you can hang on to your property for say 10 years, something like that, and it becomes very profitable. But if you can't hang on to 10 years, expect that interest rates will be up there and for a long time. If you're looking for buying, selling, or renting your properties, you can look for me. My name is Ted Lam. I'm with eXp Realty.